Hey team. So this isn't really like a professionally put together live video here. So I'm more doing this because there's something going on with my recording, and it's easier to just do it from StreamYard. So no worries if you're watching this later. It's not important to be here live. I did a call earlier today with Shabari over at OG Cyberfam, and one of the topics we were covering was in and around real estate, investment real estate, some of the risks that are going on right now. And I had mentioned sticking to the numbers and knowing your numbers. I wanted to expound on that a little bit because there's some good questions that kind of came through. Oh, hey, Chris. Um, Actually, Chris, if yeah, no worries. So this is just something from earlier, but actually, I'd love to talk options with you later, though, for what it's worth. Maybe we can even do that on a live stream and really get into that. But what I wanted to talk about real quick was 5 minute thing here. If you're in the market to look at real estate investments, you're looking for a property, you're looking for something you can rent out to folks. That's great. I think it's a super positive thing. I have a bunch of rental properties. They're phenomenal. But the thing is, you got to know your numbers on real estate. Okay, real estate is not really about the building. It's about the numbers. It's about the math. It's about what the rents are going to be, what the ranges are going to be, what the vacancy rates look like. It's about the cost for property managers, etc. So because I had seen this comment come through earlier, I just thought I'd do a quick follow up today. So I had mentioned that when we buy real estate, myself and my business partner, what we always do is we run it through our deck of our math. And essentially what that is it's our pre-built sort of qualification tool so that there's no emotions ever in how we buy. There's no questions of it looks great, it's a good neighborhood, or it's a bad neighborhood, or it's too high price, it's too low price. It doesn't matter what the price is. The price is completely irrelevant in this conversation. All we care about is, does it fit within the metrics of what we're looking for the portfolio that we run and manage? So as an example, I'm just going to give a couple high level things here. And then what I'm going to do is I'm also going to put together a sheet for the team here. I'll go over that in another call as well. I'm trying to see if I can get my business partner to jump on and talk about some of the things we do. But he's a little more shy about being on video. So in a nutshell, here's the deal, right? There's some considerations that you have to think about when you're buying investment property. And I've got news for you. It isn't just how much is the mortgage and how much rent can you get every month. So some of the things that happen is you have to be consistently aware of what you're paying a year for taxes, right? You have to know your mortgage rate. You have to know what the insurance is going to be, because I've got news for you. It's going to be very expensive for a rental property, or if it's cheap, it's going to be lacking some of the key things that are going to protect you from something happening. So just keep that in mind. You also have to consider things like vacancy rates, operational costs. These are sort of the regular recurring things that you might need to do for your property, like just regular maintenance, things like paint, power washing, maybe fixing a driveway. Someone actually just ran over one of my mailboxes the other day, so I had to throw $150 out to get someone to put a new beam in and everything else. And because I'm not local, I have to pay someone to do that. So that's sort of the operational costs we're looking at. And then we also want to start saving long term for things like capital costs. Capital costs are major things that happen once only every so often, but you don't want to get caught in a position where you don't have access to that. So I just want to give you a couple examples here of, like, when you start thinking about that rent and what you're going to make on that rent, very quickly it starts to get to a position where you're in real trouble. Chris, yeah, dude, I'll actually speak to that in a second. A really interesting story from sort of two cities over from me. Excuse me for the coughing. I don't know what's going on today. When we think about like how we build this out and how we think about the risk, right? We're taking out of our rent check right off the bat 5% for vacancy, 5% for operational, 5% we're taking out for capital costs. All that's going into a separate place where we're trying to get some sort of an earnings on it, but sort of low cost. With the markets what they are today, it used to be like throw it into like a highly functional bond fund would have been great. Now we can't do that anymore, so we have to add in a little bit more risk to make sure that money's not losing value over time. Additionally, you want to think about, are you going to need property management, right? That's going to be another 10% off the top. It could be up to 12, could be down to 8, depends on how many properties you have. We leverage a really great team that includes property management, maintenance, and attorneys. They also handle our insurance for us. So I can sort of outsource all of my work to that team. They do a great job as well. But I want you to start thinking about it in terms of like, that's 5% here, 5% there, another 5%, and then 10 on top. That's already 25% of my rent check is gone right off the bat. Now I have to worry about paying the mortgage, paying taxes, making sure that I have insurance on it. These are the considerations you have to make. And then you have to understand what's your rate of return of the yield you're trying to look for on each property. Um, my daughter's talking to me right now. What's up, honey?
Can I have 2 peanut butter cups?
Go. Yes, beat it. This is called the real world, by the way, when your kids are walking in on your live streams. And I just am calling that out because I've seen some real bad stuff in even my local area with friends of mine who are like, hey, I thought it was a great price. I'm trying to speculate. Speculation is a whole nother game, right? Real estate investing, in my mind, is investing to make a profit on the recurring revenue that you generate through rents. Okay. That is a big deal. That is something you have to be considering. You have to consider in the math. And then the other piece as well, one of the bare minimums we think about when we make an investment or decide to make an investment is we follow the 1% rule. And the 1% rule is that our monthly rent represents about 1% of the total cost that we're paying for the property. So as an example, if I buy a property for 150K, I expect $1,500 a month to come out of that. Now, I want to be very declarative here in what I'm saying. It is very hard to find a 1% property that's not a dump in a really bad area in really bad shape. So what we do is we have sort of a range of what's an acceptable monthly rate or yield to price, depending on the MSA with the major market we're in, depending on the type of neighborhood and school system. And we don't like to go too low, so we sort of have some sort of a range there. And then what we do is we look out and we start to understand what's the probability and range of where the rents are going to fall. And what we do is we calculate everything on the worst case scenario rent, and we actually subtract a few points, assuming we have vacancies and have to do something drastic to get in there. So I just want to share that because it came up earlier today, and I thought it was a really good takeaway that, look, there is a way to do this so that you don't have to wonder if you're making a good decision or a bad decision. And Chris KP in the live stream chat here, I'm actually going to pull it up here once I figure out how to do that, of course. So rental property was great. Now the risk has gone up considerably because of tenancy issues thanks to COVID. Friends close to close to bankruptcy in New York City because tenants stopped paying. So I live a couple cities over from a really popular MSA, not Boston, but another pretty major area in Massachusetts. And he had about 46 total units. And as soon as COVID hit and the sort of ability to stop paying rent hit, 50% of his 40 or so units stopped paying. And he basically had to put all of his properties on the market for a fire sale or risk losing them all. And he went to court. He tried to fight some of it. And a lot of people were hearing about it's possible to win. But what wasn't possible was, okay, fine, you win. Now, how do you get them out of the apartment? Well, you can't do that either, right? Evictions are very tough. So the more you can build in a structure of security and safety and build up that vacancy fund and build up that operational fund and build up that capital fund, the better you're going to be over time. So I just want to call that out. This wasn't meant to be a super deep dive video, but it was such a good thing that came up earlier, and we got a question in the comments about it to share sort of that sheet and how we do it. I thought it would make for a great piece. I also want to call out too for those who are sort of never done this or maybe haven't done it in a big way. I typically don't even see the properties when we buy them. In fact, frankly, I've seen almost none of them because I don't care. It's no different than me buying shares of J&J, but I haven't been inside of their warehouse. I haven't gone to their factory. I haven't walked into their executive floor to hear the conversations. For me, I'm very cold-blooded when it comes to my investments and my decision-making, and I build the decision science around everything. This means that I gather as much data as I can. I fit it into the formulas of my investment strategies. Within those strategies, we'll determine if something is good, bad, ugly, or unsustainable, and that makes it very easy. Real estate's even better because there's so many knowns. There's not a lot of surprises, right? You own the piece of property. You know it's either going to be rented or not. Your tenant can destroy it really bad or not at all, right? There's a range of risks. You build those risks into your model. Easy peasy, lemon squeezy. So with that, that's it. I'm losing sunlight out of my window here. My daughter's looking for something to eat. Thanks everybody for watching. I'm sure more people will watch this later, but for the 5 who are here right now, I really appreciate you, and I really thank you for that very much. One thing I want to call out as well, though, while Chris is here, is Chris and I were talking actually earlier back and forth via messaging chain about about puts, Greeks, volatility, where and how and what we look at when we move and sell options. I think it's a great conversation. I just said to Chris at the beginning of the call that I'd love to have him on another time. So I think we're going to probably do that and dive into the weeds of generating recurring income in as safe a possible way. Of course, all that being said, options always carry a ton of risk. So just keep that in mind. So with that, team, thanks so much for watching. I just want to get this out of my brain before I forgot to do it. Otherwise, have a great weekend. Have a good night. And also tonight, I'm going to throw out a little plug here. Chris Patel on his channel is going to be having some pretty major guests on tonight. So I'll probably be sharing that on Twitter as well. So anyways, thanks for joining. Thanks everybody for watching. Talk to you all soon. Have a good one. Bye all.